There we go. Okay, Matt Davio back at the 1 Minute Trader podcast, and I've got a returning guest. I've got Darren Newsom coming to us from DTN in Central America, Central United States of America, that is.
Yeah, Central America would be interesting. Just based here in Omaha.
Just based in Omaha. So, Darren, I wanted to have you back on today, and let's talk a little bit about, kind of the seasonality of trading, investing. As we come into the end of 2017, we've had a very one-way market in many of the markets, from financials to to the grains. They've all been pretty consistent in that they've either moved one direction, much of the year, or they haven't moved. And
right.
So I thought we could talk a little bit about kind of how in your analyst world, how you look at cycles and how you and the patterns of things, especially when it comes to the grains and weather and what's going on there.
Yeah, it's long been one of the things that I've studied. In fact, it's one of the first things that I ever studied was the seasonality of markets. In other words, how do markets, and in my world it's mostly commodities, how do commodities behave over a 12-month period? I narrowed it down to 12 months. It could be 18 months, whatever anyone wants to look at. But a 12-month period, either a calendar year or a marketing year, as is the case in grains and things that can be stored. Livestock are obviously a little different because you still look at a 12-month period, but it's not one continuous market. It's a bunch of different markets broken up over the period of the year. And what I found is there used to be a lot of consistency because, when you'd see these seasonal cycles, these seasonal patterns, they were based on fundamentals. When were the bin doors usually shut tight? So you'd get a planting season rally, you'd get a harvest, you'd get a summer scare with weather, and then you would sell off into harvest once the idea that the crop was made seemed to take hold in the market. But that's changed. We don't see those same types of seasonal patterns, particularly in the grains, and even in the energy complex. Seasonality has changed. So, as you pointed out in the opening, what we've seen for much of the last year, a couple of years, is a lot of contra-seasonal moves. And to me, it's fascinating. It kind of goes back to our previous discussion about behavioral trading. Now, once, and this goes back to, the very basics of analysis being Newton's first law of motion. We get trending markets moving. And we get money flowing in one way or the other. Say in the energy markets, it's coming in as buying. In the grain complex, it's coming in as sellers. And we can't break out of those patterns. We can't break out of those uptrends or downtrends, regardless of what seasonal tendencies, what seasonal patterns would tell us tends to occur. And so I find that an interesting change in the marketplace over the last 5 to 10 years.
And so like you see kind of a repetition in the stopping of a pattern and maybe a new pattern. Is that kind of what I'm hearing? Or is it rather not really a pattern, but a stopping of an old pattern and kind of a scatter plot today? I'm curious.
Yeah, it could very well be. Let's take corn and soybeans and crude oil and all those crude oil distillates, all those kind of move together. The only one that's kind of an outlier is natural gas. But you look at those, and they're developing new patterns, but it's constantly evolving. You can't say, okay, the last 5 years, because the last 5 years could be completely different than what we saw, what we see on the 10-year study. So it's it's constantly evolving. Now you take something like wheat and natural gas, it's more of a scatter plot approach. You have a long sideways, just a bunch of waves going over the course of a 12-month cycle, and there's no real consistency. It's not tied to any changes, seasonal changes in supply and demand. It's much more random. And so, I find this evolution of seasonal studies interesting. And, we used to be able to use those as a guide. You can still use them as a guide, but just much looser. You can't tie much to them anymore.
Do you think a lot of that is because maybe the markets are broader? They've got wider participation as far as, I'm not saying volume necessarily overall right now, but they do have maybe a more diverse set of auction participants. Would you say there's any truth to that today?
Yeah.
Or less participation? That could be the other thing, right? It's almost like one or the other. You either have more, and that's causing kind of this like scatter, or you have less, which is kind of also causing it because they're trading with themselves, the fewer participants. These are two ways you could go, and I don't know. This is why I'm suggesting it.
Yeah. I think it's the dynamics of the markets have completely changed, and this goes back in the ag commodities. This goes back to 2005, 2006, where we changed the limits that, the position limits that could be held, starting off in ag commodities. And we've seen, we basically saw the breakdown of pit trade to where everything is basically computerized now, driven by algorithms, and they're looking at different things. So we've got a completely different set of traders in there right now. It's a much more broad set of traders. And yes, they can either be in the market as they are in crude oil at this time, or they can be out of the market, say as they are in you can pull up something, just pull a market out at random where we've seen very little activity. Now, corn is interesting in the fact that somebody put it this way, so many commodities are interesting now, and that we're facing the same basic supply and demand situation of oversupply and questionable demand. I mean, we've seen it in crude oil. That's backed off here the last 3 or 4 months. I'm still not convinced that we've got this huge shift in supply and demand in crude oil that seems to be reflected in the recent market move. But you look at all of the ags, from corn, soybeans, wheat. Some would argue, you can take it on out to some of the soybean meal and even some of the cattle markets and hog markets. They all seem to be suffering right now from a situation, an oversupply situation. And so this has changed from our shifts in, we go from large supplies to tight supplies and stronger demand to weak demand. Right now, we just seem to be in an endless cycle or an endless move of increasing supplies and demand that's there, but often questionable. Yeah. So it just keeps the investment money, it keeps investment traders from getting overly interested until there's an actual shift in supply and demand, or a perceived shift in supply and demand, like what we saw in the energy complex.
Yeah. And and a lot of those investors that you're saying are investors in the energy complex also got shooken out, from the moves from, to 150 back down to 25, and then and then again shifting to back somewhere in the middle. But really, when you look at a long-term kind of value zone, crude is kind of probably right where it should be. I was looking at exactly. a 40-year chart, but you need to do that occasionally. I was looking at oil, and it looks like it's in balance on that time frame. So that kind of, and I'm kind of with you as we come into the end of the year, 2017. I think it's been a really interesting year in that it's been, in my 28 years trading, I've never seen volatility across all asset classes be as flat as it has been this year. And I always like to say that, banks still have big trading desks, and they haven't been making money for years. And they've been making money in the deal side of things. So that helps. But at some point, there's going to be some shocks here. I think that consistently are going to change this game and catch a lot of people unprepared. So, what are your thoughts on kind of, where markets are, as you come into the end of the month, the end of the year? Do you see a lot of seasonality things that you used to rely upon that you've just thrown out? And then, how do you kind of, I don't know, my thoughts on the grains particularly are, I think they've been so quiet, and you're sneakily seeing some of the softer softs like cocoa and sugar have been on the turn up over the last 6 months, right? Yeah. And nobody's really talking about them. And I think wheat, the big boys, wheat, corn, and soybeans have been, outside of one literal, couple week spike that we had this year, it's been just snoozy. So I think there's something in the offing, I think, for next year for the larger grain complex.
I agree. You brought up a lot of great points. The seasonality. What do we normally see this time of year? In the big three, particularly in corn and soybeans, cash and futures, this is the time of year when they usually start going up. We're done with harvest, everything's tucked away. And so you start to see a move in the cash market. Cash market tends to pull the futures along with it. So far, we haven't seen that. In wheat, again, there's no real solid seasonal pattern that we can hang our hat on like there used to be when we'd get a rally this time of year. And then if we look at, okay, so where are we? So we've got seasonals. We've got, the seasonals seem to be breaking because we can't get investment money coming in. The commercials are comfortable where they are right now, given the abundance of supplies that we seem to have in the major commodities. And so now if we look at where we are price-wise, and here's where we go into, where I like to look at distribution ranges based on weekly closes, and we see, corn's in the lower 5% going back 10, 11 years, wheat's in the lower 5, 10% going over the last 5 to 10 years. Soybeans up around the 33, 35%, something like that, going back 5 years. You could be argued that these markets, from an investment point of view, should be considered or could be considered undervalued and maybe a good buy.
Yeah.
So why aren't they buying?
Yeah. Well, that's a good question, and I think a lot of it is, a lot of the bigger players have been lulled to sleep. They've been lulled to sleep for various reasons, and I think the currency situation will change that.
Exactly. And that's one of the key reasons as to why everything's gone to sleep. The dollar really isn't doing much at all. It keeps, all these interest rate threats or increased threats continue to be made. Very little happens. And then when we do see an rate increase, the dollar doesn't show much reaction. And then again, we're going back to an oversupply situation. You look at the spreads in corn, you look at the spreads in soybeans and wheat. Cotton, we're finally starting to see some commercial movement in the cotton markets. Some of the other softs that you mentioned, they're not getting a lot of attention, but we're seeing those spreads tighten up a little bit. But in the big markets, there's no reason for investors, despite the fact that markets are low, to start buying. Now, corn might be the outlier. As we saw in last Friday's Commitment to Traders report, very large net short position by investment traders, non-commercial traders, that could, the low price and the fact they've already got such a large short position on, could lead to some buying, because some covering for no fundamental reason whatsoever.
Right.
And that could be something we're looking for in here. No fundamental change, but it could lead to a bit of a seasonal rally.
Yeah. Those markets that I talked about and you added in cotton, what do you see there? I mean, sugar and cocoa in the past have been significantly higher, and they're creeping up now. What do you think is causing, kind of some larger money to come into some ancillary, products, as I say, kind of out on the spectrum of the ags? Why there first? I mean, I'm just, again.
I think it comes back to spreads. If we look at the spreads, if I was an investor, I'm going to be looking to say, what market are the commercial traders in that market telling me have tightening supply and demand situation? Certainly cotton's there. We've seen the D's gaining on the March gaining on the July, or excuse me, on the May, and so on. And so if we look out at cocoa and sugar and some of these other markets, we see something similar. It's not the case in the big three. So if I'm an investment trader, I'm getting tired of being in the stock market. It's starting to look a little bit top heavy. Yeah, we've got the concerns with the dollar, but they really seem to be put on hold right now. Nothing really ever reacts to the dollar anymore. I've got to look for a commodity that may be showing me a tightening supply and demand situation, and we can only read that by looking at the forward curves. Right. If we see a forward curve that's neutral, maybe even a little bit bullish, I think it's going to start to attract some money as we head into 2018.
Yeah. What other trends are you seeing in the change of trends? That might give some guideposts to people as they come into the end of the year, because this is I also, and I'm sure you agree with this, Darren, I think this is always a good time if you are, as we're suggesting, maybe bullish in some of the larger grains into the end of the year, as it continues to kind of play the trend that it has the last 6-7 months, which is down. That's a great opportunity then to come in and say, and not get scared based upon this 40-year cycle, or not 40-year cycle, but really we're at the low end, like you said, 5%, the range side of things. You're really setting yourself up. It doesn't even, it almost doesn't even matter why it's going to move up. It just feels like, it has to.
Yeah, I'd say the one that really jumps to my mind has to be corn. There's no fundamental reason to be bullish corn whatsoever, but the fact that we've got such a large short position going right now by the non-commercial side. Again, this is just the non-commercial classification in the most basic CFTC commitments to traders report. The fact that that group is that short corn market coming up on the end of the year, farmers are going to lock bins up tight. There's not going to be a lot of cash movement into the market. You're going to see, we've already seen spreads starting to tighten up a little bit. Basis is starting to firm. I think you're going to see some corn I think you're going to see the corn futures start to move a little bit. It's going to be a great deal.
I think we did even a little last week in both corn and wheat.
Yeah.
Or was it?
It was on Friday. Friday saw a big move. We saw beans go up 18. Corn was up 4 or 5. I wasn't overly convinced by the strength of the soybean rally, but I think the corn kind of tipped the non-commercial's hand as far as what their next move might be. So I think that might have been the opening salvo. We've got some buying coming into this thing, and so it wouldn't surprise me if that continues. Everything tends to get quiet over the holiday season, so that might be an opportunity to cover some of those short positions.
Yeah, and if nothing else, how about this, Darren? At least every year for the last couple of years, we've had some big spikes in July. So if you've got a 6-7 month, not even 6 month time frame, probably be a good time to, again, just to the tight range that we've been locked in for, let's say 14, 15, 16, 17, let's say the 4 years is, on corn, it's really kind of 320 to 430. That's where we've been. I mean, what's your risk? I don't see it going to zero. So.
Yeah, and you raise a point. It goes back to your question about patterns from earlier. And if we look at corn's long-term pattern going back to 14 when we set our low in October, then we rallied up into 15. We posted a spike high in 15. Pulled back a little bit, then posted another spike high in 16. Then we fell back down to a new low, and that was important to me. Is that the August 16 low was actually below the October 14 low. Then we've hit a high here in the 17 again. We've pulled back. So I think we're going to flatten out here in a while, find some support, post another spike high in 18, and then go to another new low the summer of 18. Yeah. Now, the key to all this, Ben, is that each one of those highs have been at a lower price, and the two lows so far have been at a lower price. Right. And that, is a classic definition of a downtrend. So until we break that, I think that right now the downside's limited. But we get a little spike up, and then we sell it, and then we can go back down.
Yeah, I would say it's limited, but with the caveat that if we close, especially on like a month end under, say, a 3,
right,
3 strike, that could be the ultimate shakeout, right? I mean,
right.
I don't want to say that this is possible, but it is. If we were to close under there, I mean, anything down to 2 comes back into the card. So you just want to, for me, that's how kind of I'm looking at the risk. So you've got this month, in November of 17, and you've got December of 17. You have 2 more strikes that are going to be very important to me on the continuous contract, which right now is, we're looking at, I think, is it the H on corn. So, in that case, you're at 355. You've got to get below 3, and then again, not on a Tuesday the 20th, but the 30th or the 31st of each closing are really important. Right. So, I would continue to watch that month and see what happens. So that's
correct.
That's kind of the risk. I always like to.
Yeah.
For me.
And that, I agree with you completely on that. The risk is going back below that August 2016 low. You see that, and that kind of opens up the door. What this is all based on is that we're not going to do that yet, but we might do that next summer. Would be my target for hitting a new low.
Okay. So, Darren, I want to shift a little bit just because, South Sea bubbles, tulip bubbles, internet stock bubbles, housing bubbles. Now, I haven't lived through all of those, but I've lived through, say, 3 or 4 of the more recent ones. Bitcoin,
Yeah.
the thing, as we're talking again today, is making another new high, over
Yeah.
8,300, I believe, was, 82.63 might have been the high, and we're right at it again here. I mean, this thing is pretty wild, and CME is going to start trading it. I don't know what day, but it's supposed to happen sometime in December. I would imagine it's probably towards the end of the month. Rollover. Have you heard anything there?
I've seen it, and I don't remember what day it is that starts rolling. So, what I'm interested in is, okay, will this change the type of trade that we see in Bitcoin? Will it calm down? Will it be like bringing a sheriff to town?
Right.
Or is it just going to remain kind of the Wild West market that it is, basically capable of doing anything at any time?
Yep.
I don't know. I personally, my son, budding analyst, he's in college right now, says, man, this is still the market. I'm old. I want to see what happens when the futures, see if the futures can corral this thing at all.
Let me ask you a question. Market cap wise, is there a number for some of the, how big is the corn market when you look at how much is traded on the CME? Like, what's the number? Do you know?
I don't know right offhand. You see X number of contracts traded at the value. I couldn't tell you right offhand, Matt.
I'd love to know that information. Maybe you can get back with us, because
Yeah.
I think the Bitcoin number is pushing closer to 200 billion. I mean, I've heard, so at 200 billion, you're bigger than the economy of California now.
Yeah. I think I saw something earlier today, and maybe you're talking about something different, where its market value or market cap went beyond McDonald's today, I believe. And, so I don't know what kind of milepost that is anymore. I know it used to be significant.
Well, again, let's just compare Bitcoin to the economy of California. That is significant. I mean, California as an economy is one of the largest in the world on its own. So
Yeah.
I can say pretty confidently that I think your son's right. It's not going to go anywhere tomorrow.
Yeah.
Now, does CME legitimize it? How does it start behaving? That is what I'm curious to see myself.
Yeah.
But, it is interesting that you really have your true, your first true electronic 24/7 market. I mean, that has to stand for something. I mean, Bitcoin trading literally 24/7 around the globe is pretty powerful.
And will this become a model for other commodities? Let's say more cash commodities than the futures market. Let's say cash corn or cash gold.
Yeah.
Will we now have 20 to compete with Bitcoin? Because Bitcoin's stealing all the thunder. It's becoming the financial market of the world.
Yeah.
Without anyone even knowing what it is, without the majority of people not even knowing what it is.
Yeah.
Will gold, is gold going to be forced to follow suit? Crude oil, what's often considered one of the key financial markets, or, corn, the key ag commodity. Is its cash market going to become the next ag Bitcoin? I think these are all fascinating things that could occur over the next, I would like to say 5 to 10, but most likely 3 to 5 years.
Yeah, I agree. I think the time frames are being pinched, and I think it will be pretty exciting. And I've traded Bitcoin on some of the other exchanges, and I'm excited that it's coming forward, because that's always been my concern. It was putting up cash somewhere else where I don't really, geez, I don't know if the CME is going to be around tomorrow, but I definitely, I feel a little bit more secure there. But you know what I mean? I mean, it's
of course, yeah.
It's still to me, it's boggling how much money is flowing through some of these exchanges that literally, they could be set up, in a back server room somewhere in Omaha, as far as I'm.
Absolutely, could be anywhere. You're absolutely right.
Yeah. So I'll be watching that. To me, that's going to be. I think just based on where the price is today, I wouldn't be surprised if we see 10,000 on that thing by the end of the year. We're at 8,300. I mean, we might be there by Thanksgiving, as far as I know.
That's what I was just going to say. It could be the end of this week. You're at, there's just nothing to put the brakes on it right now.
So I really think to kind of wrap all this up, Darren, to me, as you said, markets are more dynamic than ever. Mm-hmm. The seasonals, I think part of the this is my opinion. You saw it in stocks really when they went from, stints, 16ths, 30 seconds, all the way, now to pennies, right?
Yeah.
The way that stocks, even though they didn't expand the time trading, and they may need to, by the way, to compete at some point. I think all markets will. I think it makes sense. I mean, it makes sense that markets would be truly 24/7.
Yeah.
That liquidity is really what people ultimately are seeking for. And I think if you're going to offer to people that we're not closed, you can participate, more people would, I think that seems more transparent to me than even a market that closes Friday at 1:15 here on the West Coast and reopens Sunday at 3. That gap in time, a lot of things can happen on weekends. So I think that is a macro view of mine that I think we'll see more and more of this, where markets will extend themselves to really never shut.
No, and I agree. And I wrote about this in my column on DTN a number of years ago, back when the CME moved. We almost had 24-hour markets there. It's kind of an experiment. We did this for a little while. And, I phrased it as the wider river theory. We had all of this time now so that when events happened, it was like throwing something off a bridge into the river.
Right.
Made a splash momentarily. And then because of the length, because of the number of players, because of the width of this thing, it was quickly swallowed up. And I think, as you pointed out, I think because of all of those factors, that's still why we see so many markets with low volatility right now. And if we go to more 24/7 markets to compete with Bitcoin, I think it's just going to be the fact of life. That's what we're going to be dealing with. It's going to be more difficult to trade volatility. You're going to have to trade, intrinsic value versus volatility. And then you're going to get these wild cards every once in a while with your Bitcoin or some sort of geopolitical change causing gold, crude oil, whatever it might be, to spike. But other than that, you're just going to have a lot of quiet, sideways to grinding one way or the other markets.
Yeah. Well, Darren, we'll have you back on again soon. We'll continue these conversations because, as always, they're very valid and appropriate for where we are in this ever-changing world and space that we live in every day. So thanks again for coming on. Darren Newsom of DTN, again, talking about seasonalities, talking about patterns. It's hard to keep up with.
It really is, and as always, I appreciate you having me on, Matt.
Okay. Thanks, Darren. Take care.
All right.